Hi, I'm Ashley Trelitza, here with Craig Ivy at Capital Impact Strategies. Today we thought we'd put together a quick video just talking through some of the recent market events, what we're seeing, paying attention to, and how we're talking clients through what's been a bit of an uncomfortable ride in the last several days and weeks.
Yeah, for sure. As we kind of look at um, the indices this morning, the Nasdaq is well past bear market territory, and the S&P, at least this morning, has flirted with it. So, yeah, I thought it would be a good time to walk through both kind of the financial planning aspect of working through, potential bear markets and recession, and then just give some feedback on what we're keeping an eye on. Are there anything strategically that we need to do? So, yeah, maybe Ashley could talk us through, cash flow simulation, things like that, so that maybe feel a little better about where we're at.
Yeah, so I'd say that's sort of the first place I tend to like to start with clients just because the modeling really is at the core of everything that we do when we're working with families. And one point that I always try to bring people back to is that when we build our models, I mean, they are models, we are using a statistical analysis to look at these long run projections, but part of how that comes together is that we are building in down market scenarios, similar to what we're seeing now, even worse than what we're seeing now. And so I always want people to keep that in mind that we've tested for this, right? Like it's not a perfect replica of a real life market scenario, but it's enough to instill, I think, a level of confidence that we've looked at this, we're anticipating the markets are going to be down sometimes. And so if we're still looking at those results and saying, this looks strong, you're in great shape, I think it helps clients to keep that mindset of investing for the long term. We're not going to panic when we see a dip or a correction. These things are something that we anticipate and expect the market to cycle through. So at the core of it, I think it's this sort of let's pause, let's take a deep breath, let's look, let's don't panic. We've prepared for this, and then we
Right.
can move on to maybe some of the more, economic points and data-driven things that are coming in the news cycle now.
Yeah, and probably a good thing to go through is some of the terminology that you'll see in the
Mhm.
headlines and just be more specific about what they mean. So correction is, 10% down from the peak that we experienced earlier in the year. A bear market is 20% down. Recession is a little bit different because it's more of a fundamental in that you have to have two consecutive quarters of negative growth. So we're not there yet by any stretch. I would say a lot of what we've seen over the last really 3 days is headline driven. So, you know, tariffs is what you're seeing. And there's this anticipation that will have, a negative impact on the economy. Um, and to Ashley's point, right, let's say right now the market, the most broad kind of quoted index is the S&P 500. Present moment, it's down about 19%. Um, Ashley, I think that the average bear market, which we kind of hit that in um, COVID, was probably 36 or 37%
Yeah, and that
down.
was a fast one too.
Yeah. And, but am I correct in saying that when we go through our cash flow simulations, that we are testing for markets that are significantly worse than that?
Yes, and I mean there is this sort of aspect of, how far out on that bell curve are we moving? But when we look at the whole range of trials, one of the things that we will talk about with clients is it's not just the sort of 50th percentile, that middle run, but what's happening out on the edges. And so we're certainly anticipating or at least testing against markets like these.
Right. And in those markets that are significantly down, we're still showing clients with their normal activity,
That's
withdrawals,
right.
paying taxes, gifting, all
Yes,
those kind of
yes, because
things.
we're, financial modeling happens in a bit of a vacuum to a degree where, in reality, if we did see this market downturn continue for a long period of time, people's natural inclination is, well, maybe we don't take that big trip, or maybe I put off buying that car. And when we're looking at it in a computer model, you have to make an assumption that, well, people are actually just going to go about doing what they've been doing all along.
Right.
It's hard to scale that back in the model in a way that's consistent with those return assumptions. So yeah, great point. I mean, we're taking that extra step of conservatism to say, well, the market's over here and it's doing its thing, and you're just, kind of moving along as
Right.
your status quo normal, which again is not in real life what people tend to do.
That's a good point. Yeah. So I know that there's probably, questions on everybody's mind about, where do we go from here? Is there anything that we can do? What are we planning for? So, again, like I said before, right now we're in a stage where the markets are responding to headlines and not actual economic data. So, if we were to continue to see both headlines and then add to that some economic data that was negative, consumer sentiment or companies that are reporting, revenue and profit that is
Mm.
below expectation, if we started to see a trend in unemployment or the economy wasn't adding as many jobs. So the realities that are underneath those headlines, we could see, the market fall even further, which is not necessarily a bad thing in the long run. We're always looking for opportunities to um, take advantage of pricing. So right now, we're very closely monitoring where the markets are and where they're going for potential rebalance. In a nutshell, all that means is we've got inside of everybody's portfolio, there's a mixture between the stock market and then typically bond funds or potentially individual bonds and maybe a little bit of cash. So because stocks have fallen so far, do we want to sell out of a portion of the fixed income or the bond market and buy in at these lower prices? So that's what we're presently evaluating. So typically we would use that bear market as an indicator of a need to rebalance. And then kind of the next indication would be as we get closer to kind of an average bear market scenario would be another time that we would rebalance. Um, Ashley, I'll say this, and then you kind of tell me what you think is probably the cash flow simulations that we do don't account for how we raise cash in a down market where we would,
Yeah.
pull money from something that is more stable, like bonds, rather than trying to sell something that is at a loss.
Yeah,
I
that's
guess
correct.
the simulation probably just, okay, we're selling, equally out of everything.
Yeah, and again, with the models are great and informative and very valuable, but they do come with their limitations just by nature of, you've got to write software and programming that does these calculations. So yeah, where we would be looking very strategically at a specific client's specific positions that are in their account to make our best choices for how do we want to pivot and take advantage of some of this. The software's got to make some more broad assumptions to accomplish the same end goal.
Right. That makes sense. Okay. Well, I'll kind of close with a final note is that everything is going to be okay. Um, we're not in danger of going to zero. Um, the market will, adjust and, we'll continue to go on living our lives and being successful. I would really encourage anybody that's listening to this video to look at this as an opportunity rather than something that needs to be feared or worried about, because as Ashley and I have seen throughout our careers, this is when a lot of money is made, is during these times. So we want to continue to look at this as an opportunity to take advantage of pricing. It's kind of like if something that your heart really desires, new car, new dress, new shoes. I'm going to use Ashley there, as an
Handbags, maybe.
example. um, if it suddenly goes on sale for 25 or 30 or 40% off, we look at that and we say, oh man, that's exciting.
Great deal.
We want to take we want to take advantage of that. So no different in the market. We want to take advantage of those buying opportunities. So we've covered everything very briefly and at a very high level here. So if you have any questions, or we can answer anything, or if you need a cash flow simulation run, don't hesitate to reach out. And we wish you the very, very best.